Look, we all know the regular advice to have a high credit score. Don't use a lot of credit unless you need to. Pay off your bills, that kind of stuff. This is not what this podcast is about. We're talking about advanced stuff. We're going to get highly specific, highly tactical. So if you care at all about your credit score, this is the episode for you. It's going to be awesome on the Furlo Capital Real Estate Podcast because we're diving into the intricacies of passive real estate investing. And it turns out your credit is important when you are investing. And our mission is to equip people to invest wisely in both properties and people so that together we can build wealth while improving housing. I'm James, and this is my wife, Jessie.
Hey, I was just thinking about, I don't know why I was ruminating on this, but I was thinking about like, what are some of your favorite things? I think it was because
Raindrops and roses.
Not quite, but I think it was because like previous to this, we were trying to get our dog situated, and I was like, okay, I gotta find like his favorite chewy, and it's this nasty like meaty beef tendon thingy. I don't know. He loves this thing, it's by far the longest lasting chewy we found. It's great. Shout out to Mud Pets, whatever that place is.
Eventually he's going to hit that camera because he's doing right next to it.
Yeah, he's right next to it.
But he does love it.
But then it got me thinking like, oh man, like we each have those things that are like, this is super important. This is super special. And
like a credit score.
Yeah, exactly. And I mean, for some people, maybe.
Okay.
Or like our kids have blankies. You know, it's they don't go anywhere overnight without their blankie. Like that's is important.
Do you know what yours is? Can I put you on the spot?
I don't know. Like I was trying to.
All right.
I was trying to think through. Like probably my wedding ring is like one that's like, oh my gosh, I would feel weird if I didn't have that.
Yeah.
Or if it was lost, I'd be like, we need to find it.
I've started adopting your trick with my ring, where we have one of our vehicles, a Jeep. You turn on the lights, and there's no signal that the light is on.
It doesn't ding at you or anything.
If you leave when it's dark out, and if you arrive when it's kind of light, it's a very high probability that you forget that your lights are on. Yes. And so I've gotten into the habit now, when I turn on the Jeep lights, I switch my ring over to my other finger, which feels really weird. Yeah, but that's the point, because I never forget now that the lights are on. Yep. And so that's one of my favorite things, little life hacks and tricks.
There you go.
Which what I'm about to talk about are not necessarily hacks, but these are, again, these are the fine details behind like what it takes to get a high credit score.
Interesting.
Yeah. Now, what's interesting is that like it's not just about the vanity number, right? Like how do I get to be above 800? It's really like how do I target certain scores? How do I hit certain thresholds so that I can just get really good deals on things?
So tell me, like, before we get into these tips or strategies or whatever, why is a credit score important for investing? I think I know. Because
part of it's going to depend on the type of investing you're doing, right? If you are buying the property and getting debt yourself, they care about your credit score. And
whoever's lending.
The lender does.
Yeah.
Yes. Yeah.
Okay.
Yeah, that's the big thing. And now if you're investing passively in other deals, it's not as important, but it is super helpful to still be in a good financial spot.
That's because I think, as far as I understand credit scores, if it's higher, then you are a more reliable lendee.
Yeah.
Like you tend to have paid things on time and repaid things back.
Correct. Yes.
You don't have a lot of debt outstanding and all those sorts of things.
Yeah.
Okay, so it is important if you're going to borrow money.
If you're going to borrow money, this is really important.
Okay.
And a lot of the high net worth individuals who listen to this podcast, thank you so much. Those are people who are borrowing money. Sure. Yes, they are investing with us, but they are also borrowing to do other stuff. You know, I'm not the only game in town for people in those positions. And so that's why I'm just trying to help them out, make sure they're in a good spot.
All right.
So the first one is that you optimize for pricing tiers, not perfection. So here's the thing. When you look at mortgage like pricing stuff, typically with a mortgage, a 780 is the same as an 850 as far as they're concerned. So you don't necessarily care about saying, I want to get the maximum highest score possible. It's like, I just want to hit certain thresholds. And that's what people like, that's what you care about.
Are there like outlines of these thresholds somewhere so you know like
Well, it's going to depend on the institution, but that's the kind of thing where you have a conversation with whoever you're
Oh.
lending with. Be like, okay, hey, what is that next threshold? And then the next tips will tell you or give you ideas for like how to get there if you're not in the 800. Obviously, if you're already in the 800, you're good. Don't worry about it.
You're great.
These are people who strive to be there.
Sure.
Yeah. Yeah. So like for acquisitions, again, like we were talking about getting lending, like 780 is usually, once you hit that, you're fine. You don't need to you're better off to spend your efforts in other places, like your debt to income ratio or building up your reserves.
Okay.
Or doing some other things.
Sure.
And that's the point, I guess, is like once you're at 780, don't worry about it. Move on to something else because it's the tiers that matter.
So really, this should be like tips or strategies to get you to 780.
Yes, but that doesn't sound quite as
That
cool,
doesn't sound as cool. 800 does sound better.
Here's the other interesting thing is that they tune their score to the model that the lender will use. So turns out there's more than one credit score.
What?
I know, right? So there's your classic FICO, or sometimes called a FICO 10T, but then there's also the Vantage 4.0.
Oh, my word.
Which is a different way of doing the math that a bunch of the credit unions, credit bureaus have gotten together and said, hey, here's a new modern way, more accurate way for us to evaluate it.
Okay.
And I already know you're going to ask me what the difference is, and I looked it up and managed to not write it down, so that's awesome. But essentially it has to do with like not just the number of, like one of them is about the number of transactions and payments, which I think is the classic one. Whereas the Vantage is more about the quality of them and the mix of them and the amounts of them. It's more of a blended type of number.
Interesting. So it's more weighted almost?
Yeah.
Like if you borrowed money to do something risky and then you paid it back, it counts for more than...
Well, I don't know if they do the risk, but the amount that you borrowed matters. When you borrowed it matters. The type it was, whether it was a credit line or a loan, like all those play into it. And the variety matters.
Okay. Does your credit score also depend on, I guess, is it only dependent on money that you've borrowed, or does it also consider like regular payments that you make?
What's the difference?
Well, like if you have a utility payment, you're not borrowing money, you're just making a payment, like a bill.
That's interesting.
Paying it on time.
Well, it's all about whoever reports to the credit agencies.
Interesting.
And it typically is just borrowers
Okay.
because they're trying to help each other out.
Sure.
Because if you're borrowing money, now I care about your credit worthiness. If you're just making payments, I care less about it.
Sure.
There are sometimes like some organizations like tenant software where we'll report tenant payments to bureaus to help tenants build up their credit.
Sure.
Or, hurt them, whatever. It's usually talked about, I'll help you build your credit. It's usually how it's talked about. Yeah, but typically it's for lenders.
All right.
So what you want to do is you want to ask, what type of credit score are you using? Are we doing the classic one or the Vantage? And then depending on that one, like ask them like, well, what are the things that weigh it?
Okay.
And then you specifically...
Yeah, focus on those areas.
Exactly. Number 3, I thought this was super interesting when I was reading about it. Essentially, you engineer what is reported based on the statement date, not the due date of your payment. So, for example, let's say you have a mortgage that's due on the 1st, but the statement is actually published on the 31st.
Okay.
Does that make sense?
Yeah.
Or let's say you have a credit card where you have a due date on the 5th, but the credit card statement is on the 28th. And so what happens is, even if you're they had a nice little acronym for this, a PIF, a pay in full type of person.
Yeah.
What they talk about is that, let's go with that hypothetical, you pay on the 5th, but the credit card statement's on, say, like the 25th of the month. Even though you will constantly pay it off on the 5th, you will always show a balance on the statement on the 25th.
Interesting.
So what you do...
You should pay earlier.
You should pay on the 24th.
Yeah.
Yes. And so you want to pay attention to the statement date, not necessarily the due date.
Weird.
Oh, I told you, advanced strategies. You're welcome.
It kind of makes sense because on paper, it looks like you had a balance and you paid it off, as opposed to you just constantly paid things off. You were borrowing but paying back.
And this concept's going to become really important for the next thing we're going to talk about, which is your credit utilization amount. But in general, you want to keep it low.
I always thought like I don't know.
Oh, we're going to talk about it next, but keep going. What do you always think?
I always thought that people were like, you should have a balance and then you should pay it off because then it shows the amount, of like, yeah, I borrowed this money and I was responsible. I paid it off.
So here's the advanced tactic for that, which we're getting into number 4 now, which is totally cool because they're related. Yes, you do want to have a small balance on one card.
What?
That's it. All your other ones ideally are 0, and you show a small balance on the one, and ideally less than 10% of your overall balance.
Okay.
Okay, which is and honestly, it's
so wonky.
There's a balance of like your overall credit utilization and your single card credit utilization. So let's just say
so weird.
You've got, I don't know. I'm trying to think of I'm trying to make this math work. Let's say you're crazy and you've got 10 credit cards that you're balancing.
Okay.
Again, it's crazy. And on each of them, you have a $10,000 balance, right? In theory, you're like, oh, if I want to be under 10%, I want to have one card with like a $9,000 balance. And it's like, yay, my overall credit utilization under 10%, life's good. But for that single card, it is now spiked up to 90% utilization. And that actually hurts you. And so you're trying to balance all of them out. As a general rule, pay off your cards. Like that's as a general rule. And then for one of them, keep a very small balance on it just for that round.
Why?
Because you do want to show that you are using them.
Okay. So it's not just the fact that you have a credit card open. You have to borrow against it and pay it off.
FICO itself notes that a 0% revolving card can be slightly riskier than a small reported balance.
Interesting.
Yes.
Because
I don't
they're
know why,
like,
but
you have credit that you're not using.
Yeah. Maybe you're keeping the powder dry for something.
Sure.
They're not sure.
Interesting.
And obviously for riskier, what they're just basing it off of historical trends.
Sure.
People who keep it 0, all of a sudden something bad, like statistically something bad happens or they whatever.
Sure.
If the balance isn't there. But if you constantly have one and you're constantly making payments, they go, all right, like they've lived this dream. They're not freaking out or the fact that they have a balance. Yeah. The sweet spot is called these acronyms are killing me. ASIO. All 0 except one small balance.
Piff. ASIO.
So that is the advanced strategy. Is it's a small balance
just on one.
And the way you pull that off is by paying off each of them right before the statement, not the due date.
Okay.
So it's the
combination. They work together.
Because otherwise you think like, I'm paying off my card all the time.
Yeah.
Why are these all showing a balance?
Sure.
It's like, well, because you're paying it off at the quote wrong time.
Yeah. Weird.
Yeah. Yeah. And you can pay attention to that. You just get a couple statements from the website.
Yeah. They tell you on there what the statement date is versus the due date.
By the way, a super advanced move for that kind of thing is like, let's say that you are trying to go do something and your balance is like, you haven't been quite playing that game. You can do what's called an off-cycle report. So you can pay down several balances at once, and then they should push all those updates within 48 to 72 hours. And then you can say, hey, let's do an off-cycle report. And they'll pull it again, and it should show balances are down and improve your score.
Weird. So it matters like when you pull your score also?
Well, yeah. Well, because, no. Your score is updated after every statement.
Oh.
And so you're saying, I know that was the last statement. We're going to ignore that. We're going to do an off-cycle one. Pull it again, even though I don't have a statement. Yep, that's the idea.
Huh.
But you ask your issuers, if whoever you have your credit card with, for them to do an off-cycle report to the bureau, and then they update their stuff. That's kind of the idea. Yeah. All right. So that was 4. 5. They segregate spending, because how about this? Business cards don't always report to your personal credit.
That makes sense.
And so, if you've got a business,
separate entity.
Yeah, spread it out. And so what they talk about is, let's say you've got like a big advertising or renovation month that's coming up. It can tank your utilization.
Oh, right. Your balance goes way up.
And they say some, like many, like it's saying here, Amex, Chase, Citi, they don't actually report regular activity on your personal files, though some like Capital One, which is what I have, they do.
Oh, no.
I know.
Time to switch.
Yeah. And so if you've got big projects, you just got to think about, for your own personal score, does it make sense to do it on a business card or your personal one? Because if you do a big thing, boom, it'll spike it, hurts your utilization rate, and hurts your score.
So, okay, did I hear this right? That they pull your score after every new statement?
Well, it's like a dynamically calculated score based off statements.
Okay. So the timing does matter as far as like.
Yeah, if you're going to do a project and you're not going to pull any credit for the next 6 months, who cares? Just do it wherever. It's if you know you've got something coming up, that's when if you're never going to borrow again, your score doesn't matter.
Right. Yeah. Which makes sense. But thinking about the timing of, which I remember us having certain conversations about like, okay, well, when we want to buy a property or we want to buy a house, like let's wait on some of these other expenses. So our credit score, is, I don't know, idealized or whatever.
Yeah.
And then we can do some of these other purchases afterwards.
Yeah. There's actually some really interesting math that some people do. If you're trying to get a mortgage, there's a couple things that you can do to play with the numbers. Like oftentimes you can quote buy down a point on your mortgage. You pay some money up front, you can buy down a point. But depending on where you are in your credit score tier, you're better off to not buy down the point, but to actually go pay off some debt, get into a higher tier, and that automatically lowers your interest rate. Now, sometimes when you buy back a point, it's all bundled into the mortgage, so you don't actually come up with any cash. So, depends on where you're at. But in some situations, you don't want to buy down the point. You want to get rid of a balance, lower utilization, hit that new tier, rate goes down, awesome. And it's actually cheaper in the very long run to do it that way.
Who tells you about this kind of stuff?
Podcasts like this, of course.
Because your bank doesn't tell you that about your mortgage and I don't know, the FICO people or.
No, what you do is what I do, which is you spend a couple hours doing research, learning all about it.
So you heard it here. This is where you're going to find
the
secret information for
that's the
optimizing
trick.
your
It's
credit
out
score.
there. You just got to find it all. Yeah, no, it's super true. Like, how about this one, for example? Here's an advanced one, is if you are looking to do something, if you're looking to get credit, there is a window of time where you can ask everybody and it doesn't hurt you. So as a general rule, you get the inquiries thing, like, too many inquiries.
Yeah.
That's kind of true. But as long as you were asking about the same thing, so like if you're looking for a mortgage, after you do that first one, there's like a 45-day window. You could ask 100 other mortgages, lenders, like what's a good rate, and it's not going to hurt your score.
Oh, I didn't know that.
Yeah.
Because, they essentially pull a credit report.
Right.
And then it flags that you're doing something.
You do that first one, it hits you. But the second through whatever, it doesn't hurt you, as long as it's the same thing. Now, if you're doing a mortgage and then you do your credit and then you do
like a business loan,
I don't know, a student loan or an auto loan or something like that, that's different. That's where those things start to compound because you go, wow, you did a lot of inquiries for a lot of different things. You're making, and they're not, like they make the assumption, if you talk to 100 different lenders, you're trying to do one loan. It's fine. But if you're trying to do a mortgage plus an auto plus student loans,
those are all very different.
Those are very that's where boom, you get knocked down real quick because they're like, oh boy, this guy's getting ready to spend some money.
Yeah, that totally makes sense. It's like I need to borrow all the money for all the things.
Yeah, so you just want to make sure when you're doing one thing, do that one thing and go all in. Don't just be like, I'll ask them one here and in a couple weeks ask there and then I'll do there. It's like, no. Create a focused research time period.
Yeah, because it's not going to affect your score.
Yeah, within a month and you're good to go.
Interesting.
That's what I'm going for. Huh. Also, this one, I think this one's pretty commonly known one, is you got to stage new accounts and let the old accounts season. That's a word that's often thrown around. So, in general, older cards are good for your credit. So, there's a lot of, if you're card point hacking and it makes sense that you open up a new card, you get all the points for it, that kind of stuff.
Yep.
When you shut down a card, like the length of time that card has been open helps your score.
Oh.
And so if you're constantly revolving, it always looks like you have very young cards.
Yeah.
And that is not as good for your score.
Okay.
So what they talk about is, it's a time since most recent account opening is too short is often what the code will say.
Yep.
And so, so you just want to give yourself time between new accounts and doing a major finance. You're like, if you're going to open one up, leave it open for a while, use it a little bit.
What's a while?
6 months.
Okay.
Yeah.
Yeah. 6 months to a year.
Yeah. Obviously, if you need it, you need it. But if you have a choice, wait 6 months before you open one up. Otherwise, it can ding you for that. And if you are going to do for example, I do some of the card hacking stuff, but I've got one that has been open for a very, very, very long time. And I just keep it open and I use it every once in a while. And it helps me have a very long history. But if I were to go for another mortgage, like the last card, well, I actually just opened one, I guess. But it was a business one, so it's not connected. But my last personal one was 9 months ago.
Okay.
And part of it's because I know I've got these different loans coming up.
Yeah.
So that's what I'm doing. If your average age of accounts, it's just kind of interesting. They're talking about how there's that different credit card or the different credit rating math depends on what it is. Like the old school ones, they are less forgiving on new accounts.
Oh.
If that makes sense. So they really value having older accounts. The newer ones are a little bit friendlier.
The old school lenders?
The classic FICO score.
Oh.
Yeah. Versus newer ones. So number 8, they play relationship chess with underwriters. And so like you might have like sometimes on your cards you have what are called authorized users. So like let's say I got a card, maybe you can use it, let you sign it, that kind of stuff.
Yep.
So those are helpful for some scores, but mortgage underwriters can discount or scrutinize authorized user trade lines. Yeah, because it's not just now you they have to worry about, it's these other people. So
yeah, it increases the risk.
Yeah, so you just want to be really careful on like who you're doing that with, and if you need to do it, cool, but just like be very aware of that. And on your major credit lines, you may decide not to do this. You may say like, I'm just going to keep it for some of the side ones.
So would it be better to, like, as opposed to having an authorized user to open a totally separate account, but not too close to when you're going to pull your FICO score, but have a separate account that establishes history, and you have this other user that essentially is under your name, I guess. I guess that's kind of that's more a business use in my mind, which may or may not count. But.
Other things too, if like say you do have some late balances and you're trying to get into the club, right? You want to do a late payment triage is important. So severity and recency dominate. So 90 days being late on something hurts far more than 30 days late.
Oh.
So don't necessarily focus on the biggest balance, focus on the oldest one.
Interesting.
And then work your way back.
Okay.
And that, just use that to help reestablish your perfect payment history.
Yeah.
Because, you want to get rid of, you would just want to have as long of a history as possible.
Which kind of makes sense. It's like the longer you go without paying something, it's like you must really have a problem because you're not paying this. Like this is still going.
Yeah.
As opposed to like, well, and it shows that responsibility, I guess, or organization on some level of being like, okay, this was the first one. I'm going to pay that one down.
Yeah.
I'm going to tackle the other ones.
Yeah, because you can imagine if it's one thing if you're 30 days late on it, like, maybe they just didn't have auto pay set up and they were on vacation or something.
Yeah.
If you have 90 days, that's a different story.
Yeah, that's like, no, you definitely know.
Yeah, exactly. Number 9, they use credit for insurance where you can do it legally. So I didn't know this, but in a lot of states, there are credit-based insurance scores. And so your credit score can affect your auto insurance and some of your home loan premiums. Yeah. So if you're in a state where you're allowed to do that, take advantage of that. Pay attention to it because you've got a good credit score.
Does Oregon do that?
I don't know.
Oh,
I saw California.
Kind of interesting.
California, Hawaii, and MA. What is that? Massachusetts. They do not allow it, or they restrict the use of it.
So maybe.
Yeah, so maybe worth looking into, depending on the state that you're in. And then finally, and this kind of comes back to something we were talking about a little bit earlier, but you shift limits and lines instead of closing cards. So you can request a periodic soft pull, like a CLI, credit limit increase. Is a CLI. You can request them every once in a while and then reallocate limits within an issuer to decrease a high utilization outlier. So essentially what they're saying is, like, if you've got a card that has a high balance, you can ask for a limit increase and then shift funds around to bring down that utilization. Yeah. Utilization is kind of a big deal.
Yeah, because you wanted it 10%, only up to 10% on one of the...
Ideally, no more than 10% on any single card.
Okay, yeah.
Yeah, therefore, no more than 10% overall. All right, so here's your checklist. You ready?
Ready.
This is all you got to do. This is it.
Okay.
So once you cross that 780, don't worry about it. You don't need to chase 850 for the sake of chasing 850. That's a vanity metric. Doesn't matter. Ask lenders which model they use. Are they doing the classic FICO or like the Advantage 4.0? And then plan accordingly. You want to pay before your closing statement and to keep each car ideally in the single digits of balance amount. And that'll keep your aggregate very low. And if you can, only let one card report a small balance. Keep everything else at zero. You want to put like big one-time project type spends on a non-reporting business card, if possible. And if you're going to do an inquiry, you want to do all of them within 45 days.
Right. Same type of inquiry.
The same type, yep. And you want to stop opening accounts 6 to 12 months before you getting a mortgage on something. And then you can use an off-cycle update if you got to show zero balance pretty fast. And again, you can just check for your insurance options for your state to see if you can get a good one. So, given all that, the question is, which lever of the ones that we all talked about do you think would save you the most money on your next deal?
This is interesting. I don't know. I mean, for you, since you manage all of our business things, I would think it would be like doing those bigger expenses on business accounts so it doesn't affect the personal numbers.
That's fair.
But we're also not necessarily borrowing from lenders. We're kind of
totally am
pooling
all the time.
Yeah, I guess you do.
Yeah.
But do they pull your credit report?
Oh, yeah.
Oh.
Pretty sure they do.
I guess if you go with banks and things, they do.
Yeah,
definitely.
They do.
So.
Yeah. No, even like hard money lenders, they'll ask for my credit score and stuff.
Do businesses have credit scores?
Or
do they base it on your personal credit score?
That's a great question. I actually don't know the answer to that one.
Huh.
But
it seems weird that they would base it on your personal credit score if it's your business accounts.
I think for me, it's watching the utilization rate. And paying more attention to when I pay stuff off.
Okay. Yeah, like where you're leaving balances.
Yeah, yeah. That's probably the one that I care the most about.
Yeah, you do a lot more of that, like money in, money out management.
Yeah. Anyways, so that'd be my question to you. Which of those would you find most valuable to help out your credit score? And so feel free to leave a comment with an answer. And yeah, that's what we got. So if you want to learn more about us, you can check us out at furlo.com and see what it would look like to invest with us. And with that, have a great day.